All right, so what are some of the different mortgage options? There's FHA, there's VA, there's USDA, and there's also adjustable rates, adjustable ARM mortgages.
Yeah. Yeah, each different loan type, there's a lot of differences within each of them. So for your specific situation, one might be better or worse for you. Start with the most basic, your conventional loan. For that, you're going to have, and this is for your first-time home buyer, you're going to have 3% down. For your repeat buyer, you're going to have 5% down for your primary residence. Great loan type if you want to have a pretty low down payment. 3% is pretty low for a first-time home buyer. We will get into the other ones about USDA, VA, they're 0%, but 3% not a bad option to go with, and you're not going to have very expensive PMI either. So next loan type we'll go FHA. So FHA, it's going to be for if you have a little bit lower of a credit score, and your down payment percentage is going to be 3.5%. So you will have PMI with this loan as well, and as we talked about in another video, we can refinance you out of an FHA mortgage into a conventional mortgage to get rid of that PMI. Next loan type that we'll go into is the VA loan. VA loan is a great option for veterans, 0% down, no PMI, and you get the benefit of refinancing using the VA IRRRL. So great option for you veterans, but definitely make sure that whoever your mortgage advisor is, you look into the conventional option as well, just to make sure it's not a better loan type for you. Lastly, we'll go into the USDA loan, and then we'll touch on the fixed versus adjustable. So USDA loan, it's for your more rural areas, and there is an income limit on it, so it can be a little bit more tricky to qualify for, but it's a 0% down payment loan. It will have PMI attached to it, but just a really good loan type in general for people who live in a rural area and don't want to put any money down.
So now we'll talk about adjustable rate mortgages.
Yeah. Adjustable rates. So adjustable rate mortgages, just what it sounds like. You're going to have a rate that is not fixed for 30 years. And the adjustable rate mortgages, commonly called ARMs, they will adjust differently depending on what kind of ARM they are. So there are 5-1 ARMs, there are 7-1, 10-1, all kinds of different ones out there. But basically, that first number that you're looking at is going to be how long until the rate adjusts. So odds are that if you go with an adjustable rate mortgage right now, rates are coming down, so you're probably going to refinance out of that mortgage into a fixed rate once rates get a little bit lower. So fixed rates, they are what they sound like. That rate is going to be locked in for whatever your loan term is. If it's a 30-year fixed, you're locked in for 30 years. The only way that your payment will change is if your taxes or insurance change.
Awesome. Cool.